Have you ever watched those movies where traders are frantically screaming orders, hitting buttons at lightning speed, trying to beat the market by milliseconds? Here's the thing that Wall Street doesn't want you to know. Those traders, the ones moving at the speed of light, they're actually making less money than the people who barely check their phones. Sounds crazy, right? But the data proves it over and over again. The slowest traders are crushing it while the fastest ones are burning through their accounts. Stay with me because what I'm about to show you will completely change how you think about making money. Let's start with something that happened at Fidelity Investments that nobody talks about. Their research team decided to look at which accounts performed the best over a long period. They wanted to figure out what separated the winners from the losers. Was it education? Was it access to fancy tools? Was it how much money people started with? None of those things mattered. What they found shocked everyone in the building. The best performing accounts belonged to people who had forgotten they even had accounts. Dead people. Literally, the accounts that performed better than everyone else belonged to investors who had passed away, and their families hadn't closed the accounts yet. Second place went to people who had opened accounts and then completely forgot about them. These people weren't reading financial news. They weren't checking stock prices. They weren't doing anything. And they were beating professional traders by massive margins. Think about what that means for a second. The optimal trading strategy was to do absolutely nothing. Zero trades, zero checking. Zero stress, just buy and forget. Meanwhile, active traders who were glued to their screens, analyzing charts, reading reports, making what they thought were smart moves. They were underperforming people who were literally not even alive. There's a psychological reason this happens, and it's hardwired into our brains. We have this thing called loss aversion. Studies show that the pain of losing money is about twice as strong as the pleasure of gaining the same amount. So when you're watching your investments constantly, every little dip feels like a punch in the gut. Your brain is screaming at you to do something, anything, to stop the pain. So you sell. You make a move, you try to be smart. But here's the brutal truth. That move you just made to avoid pain, it usually locks in your losses and makes you miss the recovery. Fast traders fall into this trap constantly. They see red on their screen and panic. They see green and get greedy. They're making emotional decisions disguised as logical ones. A study from the University of California looked at over 70,000 trading accounts. The researchers found that the people who traded the most earned an annual return of about 11%. Sounds decent, right? Except the market average during that same period was over 17%. These active traders were underperforming by 6 percentage points just by trading too much. If they had literally gone to the beach and never touched their accounts, they would have made 50% more money. Here's where it gets even more interesting. The same study found that when you factor in trading costs, taxes, and fees, the most active traders actually had negative returns after you account for what they could have made risk-free in treasury bonds. They were working harder, stressing more, spending more time, and ending up poorer than if they had done nothing. Let's talk about Warren Buffett for a minute. Everyone knows he's one of the richest people on earth. His company Berkshire Hathaway has crushed the market for decades. You know what his average holding period is for stocks? Forever. He says his favorite holding period is forever. He's not joking. He bought Coca-Cola stock in 1988 and still owns it today. He's been holding some investments for over 30 years. Meanwhile, the average holding period for stocks on the New York Stock Exchange is now less than 6 months. Some studies suggest it's even shorter, maybe around 5 months. Day traders hold positions for minutes or hours. High-frequency trading firms hold them for milliseconds. Who's making more money? The guy holding for decades or the people trading thousands of times per day? It's not even close. Buffett's wealth comes from patience, not speed. He openly admits he's not trying to time the market. He's not trying to predict next week or next month. He finds good businesses and holds them while they grow. Simple, boring, incredibly effective. There's a famous bet Buffett made back in 2008. He bet $1 million that a simple index fund, which just tracks the market and requires zero active management, would beat a collection of hedge funds over 10 years. Hedge funds, remember, are run by the smartest people in finance. They have armies of analysts, supercomputers, insider access, everything. These funds charge huge fees because they promise to beat the market through active trading and smart moves. Buffett bet against all of that. He said slow and steady would win. 10 years later, the index fund had returned about 125%. The hedge funds, around 36%. It wasn't even close. The slow, boring, do-nothing approach destroyed the fast-moving professionals. Now let's talk about why speed costs you money in ways you might not realize. Every time you make a trade, you pay. There are commission fees, even if they're small now. There are bid-ask spreads, which is basically the difference between what buyers want to pay and what sellers want to receive. You always lose a little bit in that gap. Then there are taxes. If you sell a stock you've held for less than a year, you pay short-term capital gains tax, which is the same as your income tax rate. That can be 30 or 40% depending on your bracket. If you hold for over a year, you pay long-term capital gains, which is usually 15 or 20%. That difference adds up massively over time. Let's say you make 10 trades per year and each time you capture a small gain. You're paying short-term capital gains on all of them. Compare that to someone who makes one trade and holds for 5 years. They pay long-term capital gains once. Over decades, the difference in what you keep versus what goes to taxes is enormous. Fast trading is literally giving your money away. There's also something called the compounding problem. Albert Einstein allegedly called compound interest the most powerful force in the universe. When you leave your money alone, it compounds. Your gains make gains. Those gains make more gains. It snowballs. But every time you sell, you interrupt that process. You take money out of the compounding machine. You pay taxes and fees, which reduces what's left to compound. You're essentially hitting the reset button over and over. Slow traders let compounding work its magic uninterrupted for years or decades. That's where real wealth gets built. Let me tell you about a study done by Dalbar, a financial services research firm. Every year they measure something called the investor return versus the market return. The market return is what you would get if you bought an index fund and held it. The investor return is what actual people get with their real accounts. For the 20 years ending in 2019, the stock market returned about 6% annually. Guess what the average investor earned? About 2.5%, less than half of what the market gave them for free. Why? Because people bought high when they felt confident, sold low when they got scared, jumped around chasing hot stocks, and timed everything wrong. Their speed and activity destroyed their returns. Here's something else nobody talks about. Fast traders think they have an edge because they react quickly to news. A company reports earnings and they jump in or out within seconds. But here's the reality. By the time you hear the news, thousands of algorithms and professional traders have already moved. High-frequency trading firms have computers located physically closer to the exchanges, so their data arrives microseconds faster. They've already bought or sold before your finger even hits the button. You're not fast. You're slow compared to the real fast traders, and you're competing against them. It's like bringing a bicycle to a Formula One race and wondering why you're losing. The irony is that those high-frequency firms, despite all their speed and technology, are fighting for tiny scraps. They make fractions of a cent per trade and only survive by doing millions of trades. Their profit margins are razor thin. Meanwhile, the slow investor who bought Amazon in 2010 and held it made over 2,000% returns. Who really won? There's a psychological concept called the illusion of control. When you're actively trading, you feel like you're doing something. You're in control. You're making decisions. It feels productive. But research shows that this feeling of control is mostly an illusion. The market does what it does regardless of your trades. In fact, your trades often hurt you because they're emotional reactions disguised as strategy. Slow traders accept they can't control the market. They can only control how long they stay invested and what they pay in fees. That acceptance leads to better results. Let's talk about stress for a moment. Fast traders are constantly stressed. They're checking prices, reading news, worrying about the next move. That stress has real health costs: high blood pressure, poor sleep, anxiety. But it also has decision-making costs. When you're stressed, your brain doesn't work as well. You make impulsive choices. You see patterns that aren't there. You overtrade. Slow traders sleep better. They live better. And they make better decisions because they're not operating from a place of fear and urgency. There's a guy named Ronald Reed who died in 2014. He worked as a janitor and a gas station attendant his whole life, never made more than a modest income. When he died, people discovered he had accumulated $8 million. How? He bought stocks of companies he understood, blue-chip dividend-paying companies, and he held them for decades. He didn't day trade. He didn't chase hot tips. He didn't panic sell during crashes. He just slowly, steadily bought quality stocks and waited. His strategy was so simple a child could understand it, and it made him a millionaire many times over. Compare that to the countless stories of day traders who quit their jobs to trade full-time, convinced they'd found a system to beat the market. Most of them are broke within a year or two. The statistics are brutal. Studies suggest that only about 1% of day traders are profitable after accounting for fees and taxes. 99% would have been better off working a regular job and investing slowly in index funds. The financial industry doesn't want you to know this. Brokerages make money when you trade. Financial advisors often make money from commissions and fees based on activity. The financial media makes money by getting you to watch, and you watch more when things are exciting and fast-moving. Nobody makes money when you buy something and ignore it for 20 years. So the entire system is built to encourage activity, speed, trading, excitement. But all of that activity is mostly transferring your wealth to other people. There's also the issue of trying to time the market. Fast traders are constantly trying to buy low and sell high in the short term. Sounds smart, but study after study shows that market timing doesn't work. The best days in the stock market are often clustered near the worst days. If you sell to avoid the bad days, you often miss the best days too. Missing just the 10 best days over a 20-year period can cut your returns in half. You need to be in the market to catch those days, and they're impossible to predict. Slow traders stay in the market through everything, which means they catch all the good days by default. Peter Lynch, another legendary investor, managed the Fidelity Magellan Fund and beat the market for 13 straight years. He once said that far more money has been lost by investors trying to anticipate corrections than in the corrections themselves. Think about that. People lose more money trying to be smart and fast than they would lose by just sitting through the downturns. Here's the bottom line. Slow traders make more money because they avoid all the traps that destroy returns. They don't pay excessive fees. They don't rack up tax bills. They don't make emotional decisions. They don't interrupt compounding. They don't try to time the market. They don't compete against algorithms and insiders. They simply find quality investments and let time do the work. It's not exciting. It won't make you feel like a genius, but it works. The evidence is overwhelming and undeniable. Speed feels like action, but in investing, action is usually the enemy of results. The tortoise really does beat the hare, over and over and over again.